Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, back at it again on February 7th, sitting here just before midday Central. How's it going in your world today?
It's great. Up here in the frozen white tundra, where it's not so bullish natural gas, it's a fine start to the day. Looking forward to the discussion this week, Alex.
Yeah, likewise. I like to hear it. I think one of the interesting things that we'll start off with is what's going on in European gas markets, and just kind of the brief overview. Had this 2-week rally with TTF, talked about it a little bit last week, popped over 1650 today, and curious what your take on everything across the pond is.
You know, I think really simply, this is the first time since the Russia-Ukraine conflict and the destruction of the Nord Stream outlet, and then on with geopolitical tensions, in some ways limiting the pipeline flow of gas to Europe. This is the first time since that started that we're getting some semblance of winter weather, albeit not a cold winter necessarily at all in Europe. But even something near normal has the nearby TTF contract trading at levels that I think you got to go back to September of 22, maybe October 22, certainly 1-year highs. So we're, just getting a reflection of how quickly a market that doesn't have the same access to pipe gas that it once upon a time did will fare, even on normal weather. I don't have the inventory numbers in front of me right now, so maybe you do a quick recap on where we are inventory-wise. Yeah. And I think that's really the primary driver. At the end of the day, it's do I have enough, do I have not?
Yeah, so kind of the rough overview, you have inventories for EU aggregated dropping below 50% full as of yesterday's data, so February 6th. And that year-over-year storage deficit is up to almost 700 BCF. And in 1 second, I can tell you the exact inventory numbers. We have...
Well, while you're pulling that up, the year-over-year level is important, certainly in the do I have enough or do I not argument. But the absolute levels at the end of the day are what determine the fate of prices going forward. And at, just under 50% left on hand with still 9 weeks or so to go in the winter withdrawal season, that can fall down to levels that make the summer refill, I guess, price risk really interesting, which is a topic we'll go to in a minute. But maybe back to you.
Yeah, the number as of February 6th is 1.96 TCF in the storage facilities. So the week-over-week change from yesterday is just shy of 164 BCF. So it's come down a little bit from that brief stint of cold that Europe had. And looking at those model runs from overnight, it did seem to shift quite a bit warmer. So interesting to see the sustained rally. But I think you had a good point about that in one of the daily market updates this week, talking about some of the storage mandates.
Yeah, there's a few people out there on the World Wide Web talking about it. And, it's not like they invented it. It's coming out of some official source. But there is a proposed plan to either put on pause or even reduce the level to which storage must climb to before next winter. So following the 2022 global BTU crisis, it was a mandate. You must fill to 90% to make sure we can make it through a winter. And then conveniently
by November 1st.
By November 1st, yes. And then conveniently 2 really warm winters in a row, that 90% proved to be far too much. And interestingly, with, as you pointed out, about a 700 BCF year-over-year deficit, below 2 TCF before the winter's over, down to 50% or less than 50% of stated capacity, there is a plan to either put on pause or maybe even lower the target for a refill. And I don't even know really what to call this other than, well, I'm a little loose-lipped, so let's just stick with the theme. Ludicrous. Absolutely just outlandish to say we are going to contemplate not refilling to 90%, or at least making that statement, or lowering it because we're afraid if we leave that target out there, prices will be too high as we set about refilling this summer. Meaning we will single-handedly drive the market higher while we're trying to refill to adequate levels. Well, let's kind of pick that apart a little bit. If you don't buy now, or you buy less now to move into next winter with, a lower amount on hand, in the event that it actually were cold, because remember, it has not been cold. Oh, let me pull up a map real quick. If we go through February 6th, November 1 through February 6th, I'm curious because it's been a few days since I've looked at the map. There is one clear winner on the it's been colder than normal. Well, I'll say two. France and Germany. They have been colder than normal this winter. Some pockets of some smaller Eastern European countries, but overall pretty near normal for the European continent. And the idea that you're going to start with less because you're afraid if you refill, you're going to be bidding up a market presents a really interesting scenario of, well, if you go in with less and it does get cold early on, then what will you drive the market to if you are trying to fill daily demand needs? And then the other really fascinating, point there is the TTF curve is remarkably flat from March, the prompt month, out through October of 25. Mm-hmm. So on one hand, you might say, well, the curve is flat, so there's no incentive to, inject early and aggressively in the summer 25 injection season. Fair enough. However, the odds of moving into a contango environment, near term, lower price than longer term, is highly contingent upon a warm finish to winter, which, like you said earlier, weather forecasts turn warmer. So maybe it's just interesting timing to make such a statement before winter's even over.
Yeah, it's a big bet. It seems like, especially as you're losing, one of your reliable sources of supply, Russian pipeline through Ukraine to Slovakia. You have more demand for the LNG regas. And so, it does seem like it's a risky bet. And one of the other suppliers for Europe that has increased its share of total supplies in the last couple of years as the Russia-Ukraine war has kicked off, Norway. Norway has a few outages planned through the spring that I think could be interesting timing as well. Currently losing about 0.3 BCF a day, but the planned outages are going to increase to as much as 3 BCF a day. So, one thing to keep in mind, I think, as Europe is now more reliant on Norway, US, and Qatar without Russia. So, the timing seems to be shaping up there. On the China tariffs, quickly looking at that, because I think that plays into the European gas situation. How do you see that playing out? Just kind of briefly touching on it. The tariffs on China with the Trump administration, China retaliated with 15% tariffs on certain U.S. energy exports, including LNG. So,
I think you cover this. Good recap. 15% on LNG and coal and 10% on crude. What happens? Does China receive less of these energy commodities based on these tariffs? And this is, I think, the chicken and the egg argument, or there's probably a better analogy for it. But who ultimately loses here? Does this tariff prevent the flow of U.S. cargoes to China? I think not. If China needs the gas, they're just going to receive that, and the importers are going to pay more for it, much like the tariffs here. I mean, at inception, it is the importer that pays the levy. Does the higher cost have them seek alternate sources? Well, I guess we're right back to saying, will China just take more from Russia? Well, if they do that, then does that make the tariff go up? That's part of this whole plan is, trying to wrangle in what is deemed to be unfavorable trade deficits with various countries around the world. But at the same time, it's a little bit of a pressure on Russia sort of situation. Honestly, I don't think there's an impact. I think the gas that needs to flow to China will flow regardless of the price. I mean, let's just use quick and easy math here. 15% in a, $10 market, which it's not, it's closer to 15. Well, you just use a $15 market, $3. I mean, it's kind of laughable. Like the JKM market is traded, in the above $50 in MMBTU, and they're still buying it. So if you need it, you're going to buy it,
right?
Regardless of whether there's a 15% tariff or not. And you need it or not is Mother Nature. I mean, if it's cold in China, they're going to be bid.
Yeah. And my only thought on that was, worst case, as you mentioned, nothing happens, or I guess best case, nothing happens for China. But on the other side, if they stop taking that, you already have alternative buyers in Europe who are going to take those cargoes. So I think in one way, if you do see a decrease in China's imports of US LNG, then you would maybe see those rerouted to Europe. What that has on TTF, I think that depends on the next little bit of weather and inventories. But yeah, kind of an interesting question. I think we'll pause on the tariffs because there's more to that. And let's jump back to the crude markets, and we can talk a little bit about this maximum pressure campaign number 2 against Iran.
Well, let's cover the.
You want to give a
little? I guess I'm going to just start with one broad statement that covered a bit and some daily updates this week, and I'll let you cover some of the details. I think generally we stick with you're the play-by-play and I'm the color announcer in this ball game. I think the one thing that needs to be understood is there will be a lot of media outlets, and certainly Mr. Trump himself, that will talk about how he was able to drive Iranian production and exports to zero. That is not true. 2020 pricing drove production and exports to near zero. And that has nothing to do with sanctions or anything of the like. So, please, as you digest various sources of coverage on this topic, know that the real numbers are, and back to the play-by-play announcer, Mr. Alex Melvin.
Yeah, I think it's interesting. To your point, you have the compounded effect of 2020 on what was kind of a slower trend from 2017 to 2019. So just kind of the numbers overview, you have Iranian output at about 3.9 million barrels a day on average in 2017, and then they dropped to 2.4 million barrels per day in 2019. And that 1.5 million barrels was over about 14 months. And that really kicked off with the revocation of the sanctions waivers for Iranian exports. And all comes back to the disagreements over Iran's nuclear program. And I think that's really at the heart of the current negotiations as well, figuring out how we, constrain Iran's nuclear program. You have some outlets like the International Atomic Energy Agency, the regulatory body for all atomic energy, is saying that Iranian enrichment is above 60%, and they're accelerating to 90%. So people are fairly concerned that they're going down the path of nuclear enrichment for nuclear weapons and not for nuclear energy. So it will be kind of interesting. I think one of the things that is interesting in 2025 that was not the case in 2017 when we did this first maximum pressure campaign is the shadow fleet of tankers that Iran, Venezuela, and Russia now have access to. They basically share this entire pool of tankers. What is a shadow fleet? It's a fleet of tankers that doesn't turn on their AIS system. So the location pings that you have from ships to shore, so you can basically monitor their location. They don't turn those on, so it's very difficult to track. They do ship-to-ship loadings. Typically for Iran that's in Malaysia, they dump it to another vessel, and then that vessel goes to China. And that's basically how China's been able to go around the sanctions and say, hey, we're not really importing anything from Iran. We're importing all of this crude from Malaysia, even though, you go one step further, can't really trace it from Malaysia. So it will be interesting to watch because they have a much more developed network. So will they be as effective?
Yeah, I can't help but for a minute, like thinking about these, tracking systems on these ships. Anybody that's watched a spy movie at any point in the last 20 years can see all kinds of footage of the most micro nuanced thing from space. If we really wanted to track these things, we could track these ships. We don't really want to. So in some ways, I think that just highlights that the sanctions are more likely than not just to create a shift in the flow of barrels from where to where. Yeah. And the ship-to-ship transfers are actually a very common thing. They occur in the Gulf of Mexico. You can't take a super tanker up the Houston Ship Channel for offloading or onloading. Yeah. So the lightering area, it's called. You sit one of these giant boats offshore a bit. You bring a smaller boat up next to it. I mean, so it's there are ports around the world. Brazil's certainly one of the largest, very deep water ports. You can pull right up to the beach, essentially, where that's not necessary. But the ship-to-ship transfers, if we really wanted to track that, meaning the United States or Western powers that want to, I guess, implement a strategy that is meant to ultimately slow this weapons-grade nuclear development, I don't know that this is really an effective measure. I think it's more we'll call this the shadow fleet. It's the shadow fleet of pen to paper mystery words that lead to mystery outcomes.
Yeah. I think there is some argument to say it's an indirect way of targeting China's oil imports and saying we're just going to make it harder for China to import a cheaper or discounted barrel from Iran. I think that could have an effect. One of the knock-on or downstream scenarios I was thinking about this week that I'm curious to hear your thoughts on is what does this mean for Venezuela? Because the first round of maximum pressure that we had against Iran, we almost overlapping timeline had maximum pressure campaign against the Maduro regime in Venezuela and ultimately targeted Venezuela's government-owned assets like PDVSA and had a pretty tremendous effect on Venezuelan crude production. As you mentioned before, also have the effect of 2020. But, I think it's, again, a slightly different scenario where the Trump administration has already sent its envoy down to Venezuela. They've had seemingly promising negotiations or talks, and Venezuela is saying they're going to accept the deported migrants, something they haven't done for about a year. And, I guess I'm curious, what's your take? Is it likely? Is it unlikely to see?
I'll back up a little bit. I think the likelihood of an impact on Iranian crude production and Iranian exports, you say they go hand in hand, is fairly high, just like it is with Venezuela. My comments earlier were more to suggest that, with the stroke of a pen, is there an instantaneous action? Likely not. You scramble and you try to figure out a way to get revenue in through the export of your barrels. And eventually the toll will be taken and it most likely will fall under the current administration. We sound like a broken record here. The most important contextual point that sits on top of this entire discussion is there's 2 to 3 times the number of barrels available in the Middle East versus what could be lost from the combined impacts on Iran and Venezuela. It's kind of an interesting one with the negotiations between the current U.S. administration and Venezuela. In the last U.S. administration, which, theoretically ended the sanction relief, which never changed much of anything, but it was, you got to hold fair and open elections or we're going to put you back under sanctions. And they said, okay, we'll do however we want to do it, and you'll keep taking our oil. And we did. And then this round, it is almost like a swap. We'll take your oil if you'll take your people back, or the people that have come through your country that we want you to figure out how to deal with. It's a powder keg for sure. I don't think Venezuela at any point in the last decade could be accused of being a peaceful, all things are just proceeding as planned nation. And, with the current path towards trying to wrestle more market share, because ultimately I think that's really what's at play. Current U.S. administration and certainly the powers that be in the Middle East are really trying to set in motion efforts to ensure that the U.S., most specifically, but we can say our neighbor to the North American producers and the leading Middle Eastern producers, so that they have more market share. And, Iran in theory is in that bunch, but, we've seen historically, this is certainly not the time or not the first time that Iran has been treated like Cinderella of the ball in the Middle East.
Separate from the rest of OPEC for sure.
Mm-hmm.
Yeah. And, talking about non-OPEC production, to your point, you have, I guess, for Saudi Arabia, basically being the primary source of barrels that would be offsetting anything that's lost from Venezuela or Iran. We also have to take a look at Guyana and Kazakhstan. So looking at Guyana, the full year production data came out recently. And so through December, we had daily output, and you have an average of 656,000 barrels per day last month. And that's up 126,000 year over year. So full 2024 average, it's about 616,000 barrels per day, and that's up 225,000. By the end of the year, we're looking at adding, I believe, another 250K from the latest project, and then subsequent plans to increase that to about 1.1 million total from Ghana's Chevron kind of consortium, or Exxon consortium rather. And then Kazakhstan, we have some news that they're expected to add about 260,000 barrels per day, a little bit faster than anticipated, which was originally June. So we'll see if they get to that total of about 1 million barrels per day from the Chevron Tengiz field. Do you have any thoughts on Kazakhstan overproducing and what that means for OPEC?
Yeah, I mean, consistent overproducer over the last year, often quoted as, officials often making statements alongside the OPEC announcements that the overproducers will get back in line in 2025. Still not doing it. Within the past few weeks, it was reported that they hit a new daily high. Your numbers on Kazakh production, I think the important piece is the foreign investment, Chevron, in the most prolific field, the Tengiz field, and the likelihood of that foreign investment just dying on the vine. In other words, we spent the dollars, sure, we'll just wait till later when you want us to. That works with purely state-owned production. Mm-hmm. Doesn't work so well when you've got multiple parties involved. I think for both Guyana and Kazakhstan, the quick take is Guyana will most likely add 200 to 250,000 barrels a day to the global markets crude oil supply, 2 to 250 each year for the next 3. Certainly looks like that ship has sailed. Kazakhstan, its contributions relative to, say, the UAE, Iraq, maybe even our, dearly departed OPEC member Angola, I think those places could certainly contribute more than Kazakhstan could. And Kazakhstan, I think, is more symbolic or emblematic of this, kind of increasing powder keg of non-compliance. Could we get to a point where there is at least a temporary fracture so that OPEC members all kind of go their own way before they get wrangled back in? There's nothing like, $100 oil or $50 or lower oil to create more cohesion in the no man's land between, let's just say, 70 and 85 Brent. Some will say, I want to do more, and some will say, no, let's not. And, I think that really that's what Kazakhstan is symbolic of, the growing discord.
Yeah. Yeah, it'll be interesting to see. I think Saudi Arabia really the main driver of the bringing the group into cohesion, see if that holds, and Saudi Arabia negotiations with the U.S. So interesting time, see how that evolves with the Trump administration. I think one of the final topics from this last week that is particularly interesting, we talked about it last Friday a little bit, just kind of our predictions for maybe what's to come, but the Trump administration's tariffs on main trade partners like Canada, Mexico, and China. We ended up pausing the tariffs on Canada and Mexico for 30 days and did not pause the tariffs on China like we mentioned earlier. But, I'm curious, has your perspective on this shifted at all? The likelihood that those actually come into place, or, any notable effects that you're watching for global energy markets?
I have to admit that I didn't think that they would actually make it across the finish line, and then they did. But then does it count as crossing the finish line when you have to go back and stand 30 yards away while looking at it? I mean, the pause is interesting. I think the potential for the, provincial governments, having Alberta truly have a voice in how this plays out, because it's not really, Canada versus the U.S. I mean, I guess it is in terms of tariffs, but the most significant impacts are regional. It's upper Midwest U.S. and Alberta in Canada, and everybody else is just a big political game. Well, other than if this truly does escalate into something that is substantial and lasting, meaning a true trade war and not just, who's got a bigger stick. Then as you move through 25, it becomes a broader impact on the U.S., whereas the food products that make their way from Canada into the U.S. could take on a far greater impact than any of the energy. It's a really interesting one, right? Like the Trump administration has, and it's not the first time, it's not just Trump. I think you see this often where political powers that be will point at energy as one of the primary ways to curb inflation. Well, ask anybody what their grocery bill is like today versus what it was like in 2021, and then have them take a look at their household budget. Where has there been a greater impact? Increasing food costs or increasing energy costs? I mean, it's kind of a simple calculation. You add up the 4 or 5 times you went to the gas station a month and the 4 to 5 times you go to the grocery store a month, pretending like you're pretty efficient at it. You don't go to a bodega in New York just to get dinner for that night. Your food costs are far greater. So, getting certainly off of our primary topic on this podcast being energy, I think looking ahead, if this does get brought back to the forefront and these tariffs truly are implemented, the potential to see U.S. food costs go up is going to be an interesting game of chicken.
Yeah, I think my take is similar, but I would look at the role of fertilizer and transportation costs in food as well, because those both come back to energy. Fertilizer derived from energy products. Canada, really interesting one, is they're one of the world's largest potash producers and also one of the largest suppliers of other fertilizers to the U.S. So you have the impact on food, like you mentioned. Automobiles is a big one, but then looking at crude from Alberta, and then some of the electricity being the other driver of inflation over the last several years. I think that, as you mentioned, really affects those border states where, depending on Canada's hydro, you have quite a bit of electricity going to, say, the Pacific Northwest and Northeast and some Midwestern areas a little bit. But yeah, I guess
there's like another, sorry, staying on the same topic, but there's another interesting one. I think we're in this, we're at this moment in time where there are a mountain of geopolitical risks. How they directly impact energy markets, I don't think any of them really should be seen as isolation. We're, kind of looking at this food and energy thing between the U.S. and Canada. Yeah. And there's another fascinating one that I think the market's kind of conveniently forgotten about. But, back at the beginning of 2024, actually, it might have even been 23, Brazil joins OPEC. Mm-hmm. And Brazil is another key nation for food exports to the U.S. or U.S. imports food from Brazil. So are we, within the next several months, are we going to see Brazil front and center in these machinations on all things energy and food?
Yeah. Yeah. A lot of grains and feedstocks for biofuels down there, Brazil, Argentina. So, I think Argentina is actually one that I'd like to do a little bit of a focus on the next couple of weeks, because they've had some interesting changes to their energy production and obviously big changes to their political arena. But yeah, do you have any final takes that you want to throw out before we sign off?
No, I think that's it. Kind of a light week this week. Just leave it with the front of the TI curve at this moment on Friday, February 7th is just limping along a little over $70 a barrel domestically. Pretty standard spread to Brent, which is just below 75 front of the curve. And you've got steep contango still for natural gas while we've recovered from a moment below $3 at the front of the curve, sitting around 335 with similar levels at the back. So, we even kicked around before this podcast started today, if there were a theme, what would it be? And it's, feels a bit like, well, where do we go from here? We've seen no material changes yet, other than weather impacts around the world, which is,
right,
what we kind of cover each time. So I think we're in a little bit of a paralysis of markets not exactly sure where the next material move is going to be.
There's a lot of headlines, not a lot of meat on the bone, I guess I would say.
Very well said.
Yeah. And with that, we will call it for this week, and I'll catch you again next Friday.
Sounds good. Look forward to it.
All right. Thanks for joining us at the Energy Desk. Again, this is a limited series, so if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.